All right, guys, welcome back. We're going to be going over basic liquidity. We covered some of it in the beginning of the video, but now we're going to go a little bit deeper into it. So let's go. All right. So we got equal lows, equal highs. These are pretty much double bottoms and double tops and the retail perspective point of view. And in order for a equal low to be valid, the left should be lower than the right. And for equal highs, the left should be higher than the right. Now there is scenarios where they're perfectly equal, just like that. This is not a equal low, and this is not equal low. This is not a equal high. This is not equal high. Okay, only this one, and of course when they're perfectly together like this, or even, should I say. All right. So we got equal highs, equal lows. We have trend line liquidity. 1, 2, 3. We have bearish trend line. Most likely 1, 2, 3 touches. That's the average retail number, right, of touches that they're expecting. Then we also have SNR liquidity. So support and resistance levels like that. That becomes liquidity, the liquidity to us. And then obviously we have every high and every low is liquidity. And that's just every structure high and every structure low. All right, this is quite obvious. There's liquidity in every high and every low. If you know what you know, that there's liquidity in every high and every low. So now let's put this into some examples. Right, so we have a low, then we have a high. So strong low, weak high. That's our overall target, right? So price break structure, price goes up, and this point right here was supposed to take out that low. And if that high fails, that's what we call a what? A failure swing, or in other words, a weak high. So price does this, it takes it out. That becomes the inducement. That becomes the inducement. All right. Then price comes into a point of interest right there. And then what did price create? It created equal lows. Now I want you to understand something. Price needs a reason to go somewhere. It needs a reason. So it builds up liquidity. So once that liquidity is built up, it gives price a reason to go there. And that's important to understand. It doesn't just randomly do something. It needs a reason, right? A cause and effect, right? So this is the reason why price came here. Not only that, we also have our range low. So equal lows and range low. And then price takes it out. Then what happens? Pulls back. And let's say this happens, right? And then it cuts into a POI right there. So now what was price doing all of this time while this was going on? It was also creating trend line liquidity. They're expecting a third touch. That's the retail's perspective, expecting a third touch. Right? Not only retail, right? Maybe some other traders, but they're expecting a third touch. So what happens? Price pushes up, takes them out. It gave it a reason to go up. It was building already liquidity above when it was going down. It took out sell stops, sell stops. At the same time, it was building up the buy stops. Right? There's pending orders here. And not only that, you also have the people that have their stop losses up here protected on the swing points, etc. And then what happens? Then price pulls back down. It takes out all the buy stops. So they get triggered, then they get taken. These guys get triggered, then they get taken. Full of manipulation. Look into another example.